Hello everyone, welcome back to Just Invest Today. Today we're talking about the two stocks that I bought in July. They might be controversial. I don't know. Maybe you like it, maybe you don't. And I'm only saying that because it's not the same bet that I made on Meta when it was 190, 180, 120, or when I made a bet on Baba. I knew the moat will last, had a high probability that sufficiently the companies will grow into the future, and they have like a lot of assets to back it up. One of the stocks have that, but one of the stocks kind of don't have that. So these two bets are more on the speculative side, but they're still good investments in my opinion. So tell me if you agree with these two picks. So the first pick I'm going to get into, it's Aritzia. Aritzia has been getting killed in the market. It's been getting hammered, all because of the deceleration of revenue growth, of the earnings growth, and kind of what they're doing to expand. And the expansion is all a part of my thesis. Aritzia is a Canadian retailer that sells women clothing. Aritzia calls it everyday luxury, so the products are kind of more on the high end. They're not the cheap products like Shein or any of those other brands. It has that kind of boutique feeling, so it's a lot of customer service, a lot of customer reps trying to sell you high quality products. So that's what they're kind of going for, that like mid to high end tier customer. So right now in this market, it's kind of hard to do that. That's pretty much why you're seeing this huge deceleration of revenue growth at this point. But I still believe in the brand, and that's why I kind of wanted to invest in this company, because when you look or when you talk to any girl, like Aritzia has been going on since like 1984. So this brand has stood the test of time, and that's kind of why I really like it. The fact that this brand is still popular in today's time since 1984 is insane. Brian Hill also has a 23% stake in the company. That kind of has me really bullish on the company as well. The fact that Aritzia stock has crashed more than 45% over the last 6 months, I'm still hopeful of the stock and the company, because my thesis is that the brand is still going to live on to the next 5, 6, 7 years and get around like a 15% growth rate. Especially when you kind of look at the past. Even though the past is not an indicator of the future, I still think the brand has a lot of spark. This brand hasn't even hit the tip of expansion in the USA. It just started to expand in the USA, and it was growing so fast in the past. And they just bought reigning champs, so they're kind of getting into the men's section. That's kind of an add-on. I see the positive kind of piling up. But in this economic time, it's pretty much hard to see like what is this brand gonna do, because people still think that retailers and people that sell clothes, like it's still a flimsy kind of customer base. So it's hard to get people to invest in this company, and I see why people do not want to invest in Aritzia. That's how you have to be very careful with Aritzia, because it's just a trendy kind of industry. Fashion's always changing, the trends are changing, everything is changing. So you have to have a good management team, and that's why I have confidence, because I feel like the management team is good. Jennifer Wong has been in the company for like 12, 13 plus years. We still have Brian, the founder of the company. He's still in the background, still has a board seat. So that's amazing. And they've been kind of doing their thing in this section. So that's where I see the positive, but we know the economy is going through the gutter right now. People are not trying to buy $100 clothes or $150, $160 clothes. It's kind of hard to sell that as much now. So that's what we're kind of seeing in the market. Look what happened in the latest quarter for Aritzia. It was kind of bad. Revenue grew 13%, which is pretty good. EBITDA decreased 54%. Company expects net revenue in the second quarter of fiscal 2024 to be flat to slightly down. That is insane compared to the second quarter of fiscal 2023. So that's why people are getting worried. Plus, inventory for Aritzia is still skyrocketing. So people are like, what's happening with Aritzia? Are they not able to sell their products? Are they going to have to like decrease the prices because it's still a high-end brand? Before we get into the numbers, we have to realize that Aritzia is doing a lot of reinvestment into the business. They're building a 550,000 square foot distribution center in Toronto. They're actually expanding a lot of their sites right now and kind of increasing their square footage in them. So they're doing a lot of like reorganization. They're hiring a lot of workers. So that's having an effect on the free cash flow, the net income. Plus they're saying inflation, plus they're saying freight costs and a lot of the increasing costs that's dealing with all of that. How much you want to believe in that? They're talking about office space. Is that just an excuse, or is that really going to affect the numbers? And I think it's kind of fair to say that. But let's get into what's been happening. And this is not just a pandemic company that a lot of people want to say, because from 2018, 2019 to 2020, they were growing 743 million to 874 million to 981 million. You can't say it was just a pandemic company, because before that they were growing crazy. So overall, until 2022, it's been a 90% CAGR in revenue growth, and net income has been a 29% CAGR. So you can kind of see why this is a very established kind of bullish thesis to go into buying Aritzia. But remember, the past results don't mean this is going to happen into the future. So they have been really building their e-commerce presence, and that's fueling the growth like crazy. Their US income now is higher than the Canadian income, and it hasn't touched the service, like I said before, of the US growth. It hasn't even touched. We're building out 8 new boutiques, including 7 boutiques in the United States and 1 in Canada. They've never closed down a store yet. With 46 boutiques in the US today, we have a significant runway to grow. And this is what I'm saying. We have identified a minimum of 100 locations in the US that meet our exact criteria. We plan to open 8 to 10 new US boutiques annually through 2027. And they announced that they're going to generate $3.5 to like $3.8 billion of revenue. And right now they're at a starting point of $2.1 billion of revenue. If they can hit that mark, let's see. Plus, they're saying that they can actually expand margins significantly since they're doing all this expansion, and that's killing their margins. So if you see margin improvement plus this revenue growth, that's going to have a huge impact on net income. So this is what they're projecting, and you got to be careful with projections, because especially in this economy, it's kind of hard to do kind of crazy sales, and we don't know what's going to happen in the future. Are we going to go into a really, really rough recession? This can very well impact the numbers, but I still believe in the brand, and that's what I'm going to keep going back to, because that's why I'm confident in the future of Aritzia, because the brand has still remained strong throughout the history of the company. So that's why I can rely on, even if it doesn't reach these projections in 5 years, maybe in 8 to 9, maybe in the 8th or 9th year, who knows? Let's see what happens. So the second stock I bought in July is a company called Auto Home. This company is based in China. It's kind of like a Carvana type company. It's an auto service platform. It's a marketplace where you can buy used cars or new cars from, which is actually a really interesting proposition. 21% of used car sales were actually on this platform. So it's the leading platform in this sphere, which is amazing, but that's not why I bought this company. When you really break down the numbers for this company, it's insane. It's all about downside risk for me in this company, but it does come with some risk. So we're gonna do a quick analysis on this company. So remember, this company is the leading company in online sales for used car transactions in China. So that is their moat, but that sector is actually becoming highly competitive. And that's what the big fear is at this point, because look at the market and look what it's saying. Over the past 6 months, Auto Home is actually down 18%. But the crazy thing about this company that I'm seeing in the market, and I honestly don't understand it, but this company is trading for $3.9 billion right now for the whole company. Look at this. The company has $3.3 billion of net cash, with cash and short-term investments. So net cash is at $3.3 billion. That's pretty much the whole market cap, because when I bought the company, it was selling for around that price. So I'm buying this company pretty much free because they have no long-term or short-term debt. That's basically covering all my downside risks with this company. Then let's get into the negatives. It's based in China. Everyone knows and everyone hates China. So we had that fear of the company, and we know the Chinese market is just not doing well at all this whole year. So that's weighing down the stock because of the VIE structure. Also, we have competitors getting into this field, which is kind of taking market share. So you have that risk as well. Plus, they're not using their capital as efficiently as pretty much the shareholders want, because they're not buying back shares, which they can buy back a ton of shares. They're giving you a little bit of a dividends, but it's not that high. So people are kind of worried, and they're expanding. So are they going to use this capital kind of effectively or efficiently? They still grew 4% for the quarter. They're still generating $142 million from operating activities just from this quarter. So overall, they're still generating like $400 million of operating cash flow. So you're getting around a 12% yield on your money right now by just buying the stock. This is not taking out all the cash and all of that. Just buying this company right now for what it's worth. So man, you're getting amazing deal, but you still got to do your research to see if they're going to use this capital efficiently or are they going to waste it all on their future growth. And I don't think that's going to happen because they're actually generating cash for the business and they're seeing a lot of opportunity in the sector because the EV market is expanding like crazy. China sales for EV is expanding. The used car market is going to expand as well. So I see them actually staying consistent. But guys, tell me what you think about these two plays. Like and subscribe to my channel. Peace.